jump in and interrupt just because I know Bill doesn't have a lot of time. So I do apologize, Jason.
Oh, yeah.
Bill, good to have you. I appreciate you making the time on the weekend.
Sure. Important subject.
It is,
Hey,
and I think the timing is pretty perfect. So maybe if you don't mind giving us a bit more clarity on the tweet, if there's anything else you can elaborate.
Yeah, look, I think it's highly likely, based on at least it makes sense, and also the source that I spoke to, that there will be a distribution to depositors, uninsured depositors, early next week for something in order of 50 cents on the dollar, and the balance to come with the progress of the liquidation, estimated 3 to 6 months, and you sort of get what you get. And depending on how well it's done, if it's a fire sale, it's more likely, high 80s, low 90s, and if they do it better, it's probably mid to high 90s.
So, Bill, hey, nice to meet you. I was gonna ask you, how much of, I know you make a lot of investments. What percentage of your portfolio would you say has been affected by this?
None of our, my day job is in managing, Pershing Square, and I invest in, very well capitalized, Hilton, Universal Music. I would say really no impact there. I have no direct exposure to Silicon Valley Bank. I'm an active I'm more an investor in venture capital funds, and I'm an investor in, startups personally, and I'm sure some percentage of those have some exposure. So I probably have some indirect exposure, but it's not material to me. I would say what would be material to me would be this, we're kind of long America. So, if the government does the wrong thing here, I do see a, domino effect, beginning shortly. And I think that could have a pretty negative effect on markets, capital markets. I mean, we'll be fine. We're not a levered participant in the capital markets. I just think it's bad for America, bad for our competitiveness, bad for, I think of the, our startup community, our available, it's one of the important competitive advantages of our country, and an important driver of growth is the kind of startup ethos and community, and this is has become a pretty important part of it.
So there's been two narratives that have been spun, Bill. One narrative is kind of what I was mentioning and you just mentioned, which is this is too important to fail. We can't fail the innovation economy, especially because we are currently in a race for innovation with an adversary. But there's another part of this, which is, hey, there's nothing to worry about. There's a very low risk of contagion effect. This is not a big deal. I've read your thread that you put in, but I'd love for you to explore why you think that is misguided, thinking that this couldn't lead to a contagion effect that could then affect the average American.
Sure. So, I would say no one has had to think about, am I an insured depositor or an uninsured depositor? And people have operated as if this is not an issue. And effective Monday, if people banked with SVB find out they're only getting 50 cents and they're not guaranteed to get their money and it's going to take months, that's kind of the crossing the Rubicon moment for uninsured deposits. And if you're a corporate treasurer at any company, you're CFO of a startup, you're CEO of a startup, you're a venture capitalist, you're an investor in growth companies, one of the demands you're going to require is that they keep their money in JP Morgan or B of A or, Citi, that you sweep all your cash into US Treasuries. And, you're allowed to fail in the startup world, but this will be not a place, post SVB, this is not an allowable point of failure, right? Because it's, again, it's right. Totally asymmetric, right? Maybe there's some convenience factor. I don't know enough about SVB and the kind of user interface, but I assume it's very good compared to some more traditional banks. But that's about it. It's not like you're earning massively more return keeping your money there, right? So you're not earning an incremental return, and why take any risk, sort of whatsoever? And that's, and the most sophisticated depositors are generally the largest depositors. That money will leave very quickly. And so, you can just line up, the banks in the country and take a look at their exposures, and there's just no incentive to bank. Once the depositors here, if they're not made whole, immediately, and in fact, everyone's going to leave. There's sort of a hierarchy of banks. You can rank them. You can look at which stocks went down on Friday, but the same thing's going to happen on Monday. In fact, the stocks will go down. People will, they'll run for the exits, and you have a classic. It's like it's before we had FDIC insurance, right? The introduction of insurance way back when was to solve this problem. The problem is they've created two classes of banks. They've created the too big to fail, so-called, SIFI banks,
the big four,
and then it's more than the big four, but it's a handful of banks, and the rest of the banks. Why would anyone bank? And if you think about how important kind of the community banking system is, it's often, you're not going to get a loan from B of A for some small project in Iowa, right? If you're a small business person,
yeah.
Right? You need a relationship with your local banker, but if you can't keep your cash there, right, they want to have access to low cost deposits that will affect their ability, to make a working capital loan to or a mortgage to someone buying a small industrial building to open a factory, right? We need this sort of network of community, and regional banks to finance not just growth companies, obviously, but to finance kind of mundane businesses, restaurants, et cetera. We can't have all of the deposit capital flow into the big banks, and that started happening on Friday.
So before you came on board, Vivek Ramaswamy, who is a former tech entrepreneur and is current presidential candidate, he brought up his opinion on this, which was that we should just let capitalism do its work. And this is part of the normal capitalist cycle of the boom and bust cycle. And that this is just something that we should let happen. There should be no form of bailout. 250K for those people that not even the 50%, 250K, which was promised on the FDIC. We should not have a repeat of 2008. We should not be bailing anybody out. We should not be bailing the quote unquote elite out. And so that is one approach. In your thread, you actually recommended a completely different approach. What do you think we should do here?
Sure. So I like Vivek. He's a friend. I actually, in effect, helped launch his campaign with a tweet. As I said in the tweet, I don't agree with him on everything. And despite the fact he's a very smart guy, where he's correct, okay, is the equity holders of, Silicon Valley Bank should get smoked. Okay. The holding company bondholders probably should get smoked. Just whatever capitalism says. And I can tell you what I would have done differently if I was the FDIC. You don't protect. And the word bailout, I think, it was a mistake in my initial tweet on this a couple of days ago, using the word bailout. By bailout, I didn't mean bailout equity holders, bondholders. I meant protect the depositors. The banking system does not function if people don't trust banks. And your typical depositor, who's got even $1 million account at a bank, doesn't have the time or energy, resources, or often the financial acumen to figure out whether the bank is safe or not. They have to trust the government. They have to trust the rating agencies. They have to, because they got other things on their mind, right? Once you say, okay, depositors are at risk, then depositors have to be, really careful about where they put their capital. And that is a world in which the default decision is you just go to JP Morgan. And JP Morgan, I'm sure all the big banks are calling around to their clients and saying, hey, if you have money elsewhere, you don't feel comfortable about it, we'll happily set up a new account for you over here. And so there's the system, the deposits are draining and began draining over the last, couple of days from smaller banks into bigger ones. And ultimately we'll end up with three banks. And I just think
and that's obviously awful for the economy.
It's a disaster.
And so, as we look forward, sounds like what you're recommending is the FDIC make everyone whole.
Actually, what I'm recommending, the smart strategy here, the FDIC should think like a distressed investor. What they should have done is they should have announced that they were guaranteeing deposits. Hold on one second. Sweetheart, I'm just on the... Okay, that's beautiful. My daughter, by the way, just learned how to poop in the potty, so just wanted to make sure everyone knows that.
Congrats. That's a big
Awesome. She said she's very excited jumping around. And by the way, this is about, kind of like the next generation, right? If we screw this up now, it's not going to affect me personally, but it's going to affect a lot of.
She's so proud of her deposits. That's awesome.
All right, so her question was, how do I stop myself from
deposit.
sucking my thumb? Because that's her last big problem. Don't put that in your mouth.
Okay.
All right, sweetie, go to mommy. Okay.
Mario, I think you're gonna crash, because it says connection issues.
Okay.
Oh. Yeah.
Okay, I'm sorry. Where was I?
Bill.
Where was I? Okay, so
yeah, we were just talking about how.
Yeah.
This
So
is
what the
bad
FDIC
for the
should have done here, okay, is they announce that they're guaranteeing deposits, okay, and then they manage a process over the weekend where, first of all, some combination of Sequoia, GA, Andreessen, pick your list of favorite venture capitalists, and the more the merrier, form a consortium. They also team up with someone who knows something about banking. I'm happy to participate in that, that kind of scenario. And the bank gets recapitalized with a fortress amount of additional equity. The underlying, securities are sold at market prices, and they're liquid. You put the assets in, short-term U.S. Treasuries earning 5%. And you replace the senior management of the bank. You get rid of the board of directors, and you reboot. And by the way, there's a real franchise value here, right? This is a 40-year-old institution that's built relationships with a network of very successful venture capitalists, growth companies, and you move forward.
Let's see if we can get him in, and I think it's a good time because all of us want to get a bit of a break. So, be good to have Bill. Yeah, Bill, you're back.
Sorry about that, Bill. You're back.
Yeah, it happens when we go on for a long time, after like 10 hours or so, and we get a big audience. We had Mark Cuban earlier. Now, of course, with you, we had a big audience come in, so it does crash. But you can hear us, yeah, Bill?
Bill, you're muted.
Can you hear me?
Yeah,
Yes,
we can hear you now. Yep.
Okay, so what I was saying is, I think the right approach here, they announce, and they could do this on Monday or Sunday night. They announce they're guaranteeing deposits. The bank is they're going to run a process to recapitalize the bank. A group of the top venture capitalists get together, and I think the more the merrier, with a number of leads, going to be proportionate to the assets that they manage. They commit. We decide on we figure out how big the hole is, right? So we sell. The FDIC manages the sale of the MBS portfolio, and the kind of 3-year duration treasury portfolio. And by the way, the decline in yields over the last 2 days, as people are dumping, pulling their assets from banks and putting them into short-term treasuries, is actually helping the situation a fair amount by bringing down yields, increasing the value of their assets. You sell into that, and then you have the most liquid one of the most liquid large banks in the world, where you got $120 billion in short-term U.S. Treasuries earning 5%. You've got the balance of the portfolio in, I think, pretty good. When I took a look at the bank, about 55 billion of it was, these loans to venture capitalists and growth private equity people, and it's basically a loan that they use, as for sort of working capital, where they fund investments and they call capital from their LPs, once a quarter or something. Those are very safe loans because they're ultimately backed by, a bunch of pension funds and high net worth people who commit to make investments in these various funds. And so I think the asset side, can be very quickly made to be fine. And it actually shouldn't be that hard a bank to due diligence. But I think, the process of liquidating those assets will create a hole in the balance sheet. And then you fill the hole, you overcapitalize the bank, and you go forward. But it doesn't work unless we're in a world in which the FDIC is guaranteeing deposits. And I think, you can have some threshold. I mean, if you move the 250K to, you should take a look at what's a reasonable amount of working capital for a company to keep in a bank. And, you could say 25 million or some number like that. The FDIC moves up to $25 million. And then the bank is back in business. We punished the equity investors who didn't properly oversee the institution they were a shareholder of. So the old equity investors get smoked. The new investors, should make an attractive return. And the FDIC, you give them a pile of warrants, for their stepping in as kind of the lender of last resort, as the guarantor. And life goes forward. And by the way, that could be announced on Monday, and you give this group a sufficient time to do due diligence. It's not going to take very long. In fact, if it's a bunch of venture capitalists that know these assets well, it should go pretty quickly. And I think a week later, you could announce a transaction.
And Bill, in the interim, this is this sounds incredible. And honestly, if it turns out to be this way, it was broken here that Bill was mentioning this. But, one thing that in the interim, or even from now moving forward, Silicon Valley Bank was such an important institution. And even when we got wired a check from an RVC, it came through SVB. So it's such a, as you mentioned, they were involved in providing a credit line for the VC before they could do the capital call on the LPs. On the LP side, from an LP perspective, how do you see this loss affecting the venture economy?
Well, it's a black eye in the venture economy. If LPs are okay losing money because they understand that venture capital, not every investment works, right? And some vintage funds do better than others. But what they have zero tolerance for, I would say, is losing money because they're, the sponsor put the money in the wrong bank account, or their underlying companies, took credit risk on something they should take credit risk. People want to take the risk that they intended to take, right? The risk of investing in a venture capital fund, the risk of investing in a startup is, the underlying businesses fail, and you don't have enough successful ones to make up for the losses, plus an adequate return. That's what people signed up for when they signed up for venture capital. They didn't sign up for, whoops, the money disappeared because the bank I kept it in failed. That's not a acceptable outcome.
Yeah. And taking another step back further, we've never seen, and Cantro on the stage mentioned this earlier, but I'm going to mention it one more time, which is we haven't seen the Fed ever do something like this, something so unprecedented, where they had quantitative tightening, rate hikes like we've never seen before. And at some level, the Fortune article that was in the nest earlier, but now that we're in a new space, it's not there. The Fortune article, where they showed that we actually deregulated and reduced the burden for stress tests for, small to medium-sized banks, all three happening at the same time. Which of those do you think that the Fed is at fault here?
No.
Hey, can I just correct that? It's the third variable wasn't QT, but sure, we can add that. It's commercial bank lending standards being aggressively tight.
Yeah.
Yes, commercial bank. Yeah, go ahead, Bill.
I think none of that is responsible. This is a case of basic banking 101, right? Your principal job managing a bank is making sure that your earnings on assets exceed your cost of liabilities, okay, and you're match funded, okay, meaning there's no scenario in which you find yourself with long dated fixed, basically buying I think what happened here fundamentally is there was a huge inflow of deposits because of the massive amount of money that went into venture capital funds and that ultimately went into startups. And SVB couldn't find places to, make loans. So they bought treasuries, but rather than buying short dated, and they bought treasuries actually, and worse, they bought mortgage-backed securities. Now, the credit quality of these instruments is effectively, it's all government guaranteed, but they took duration risk, right? And when you, buying MBS, when rates are where they were at the time they bought these securities, in front of a big rise in rates, is catastrophic in terms of you've actually taken an enormous amount, not of credit risk, but of duration risk, and that's what went wrong. So that was a basic management failure of the bank, and the reason why it happened is likely they wanted to continue to generate earnings, so they would meet their guidance. And if they took
Bill, are they alone?
If they took all that capital and invested it in short dated instruments that better match their funding, they wouldn't. There was not enough. There was spread, if you will, between deposits and what they could earn on really short term instruments. So that's what drove this failure. This was a management failure, and it was a board oversight failure of this institution.
But Bill, to play devil's advocate, are they alone in this practice? Do you think that this is a common practice across many smaller banks?
No, I think they had a couple of problems. One, I think they're not alone. I'm sure there are others, but I think of big banks, I think this was, we did actually kind of you can fairly easily, there's a ton of data on banks and look for where the problems are, and they're clearly an outlier in terms of this exposure, but they had a particular risk that I think is not present at almost every other bank in the country, which is they had such an industry, they had correlation killed them, right? All their clients are basically in the same business, and they don't have a real, if you think about stability of deposits comes from, Bank of America having, 50 million Americans having a savings account. Right. And often at levels, less than the FDIC guarantee. Here you had, I think, a very large number of business accounts, where the amount invested was in excess of, the FDIC guarantee. And that money, again, I'm not a client, but I assume the user interface is really good here. And it's incredibly easy to wire your deposit out somewhere else. And so the moment the storm came, and also you had a community connected on Twitter, right? So, when Peter Thiel says, okay, pull your money, and, there's one story in that everyone in the community learns immediately. And so, boom, you're done. And I think that feature, feature's unique of this institution. But now that it's happened, okay, the world has woken up, and, it's unfortunately, absent the federal government stepping in here, I think the most probable outcome is we wake up on Monday morning, if these depositors are going to lose money or lose access to their money, you're going to see capital flight, very rapid capital flight from, at a minimum, the smaller institutions, but also ones that have exposures to the same, space, growth equity, private equity, venture, and this, I'm not going to name names for obvious reasons, but that's not a good outcome.
Bill, I was just thinking about sort of the second order effects of that, what you just mentioned, which is
Pranav, go ahead.
Which is, the second order effects of depositors having to wait 3 to 6 months to get half their capital back, and the flight of capital from regional to the systematically important banks. If you set that precedent and you have a whole bunch of failures of regional banks, what does that ultimately mean for the economy, in your opinion, in terms of where does unemployment go in that scenario? Is it too early to quantify that?
I think it's hard to quantify, but at the absolute minimum, it's going to massively increase the cost of capital for these smaller institutions versus the bigger institutions. And that's going to increase the cost of capital for everyone they lend money to, right? So the point here is, in order to keep money from going to the bigger banks, they're going to have to pay more in their deposits at a minimum, right? That's the best case outcome. They pay more on their deposits. They need to earn, they don't have the same economies of scale of big institutions, so they need to earn an adequate spread. It's just going to increase the cost of capital kind of system-wide for businesses that rely on community banks and regional banks for financing. It's going to put a lot of, it's going to put a stress. It's going to make a lot of projects not viable. It's going to have very significant economic effects, profound economic effects, actually targeted at, the not, big companies. Big companies have access to capital markets. They can issue bonds, et cetera, and they can certainly they get the attention of the big banks in terms of making a loan. But it's, again, the best case is it increases the cost of capital for all these smaller banks around the country.
Yeah, Pranav, we're going to go to Michael Cantro for a follow-up. Michael, question for you. Do you agree with Bill's concerns, and do you have a question for Bill?
Yeah, yes and yes. Bill, this is probably the best advertisement to all of America that there's alternatives to low yielding savings accounts. So this probably just speeds this transition out of low yielding savings accounts anyway, regardless of how this plays out. You started to talk about, before the space broke, about what you would have done, and then when we came back on, you continued that. And I don't know if that sounded like what you thought was going to happen. Given the last tweet you just put out, that they're going to, it's going to take 3 to 6 months till there's any clarity. Obviously, that creates a lot of uncertainty between now and then. But what if that's how it plays out? What needs to break to get something to actually backstop this entire thing? And when do you think that could happen?
Well, it depends on whether the FDIC and the Treasury and the control of the currency are listening. Okay, and I think if I were there, I would be. And I'm sure that why did I tweet this out this morning? Because I woke up and I'm like, okay, the government's doing the wrong thing again. It could really destroy the economy and cause a lot of hardship. And what do I think they're going to wake up and say we have to guarantee deposits. And what's interesting here is this could be a money-making, if the FDIC is smart about this, okay, if I had the ability to guarantee deposits, right, as a fund manager, right, I would step in, I would guarantee deposits, and or forget fund managers, just think the FDIC, step in, guarantee deposits, everyone can breathe, okay, and then say, okay, this is an amazing franchise, and you bring in a consortium of investors, to take over the franchise. And by the way, you can have a competitive process because now you've got once you guarantee deposits, everyone can breathe, right? But you can't just guarantee SVB deposits. You have to say, okay, we're going to guarantee deposits everywhere. It's a bit like during the financial crisis, the government stepped in and guaranteed money market mutual funds because there was a run at money market mutual funds. Kind of very similar thing. The one fund broke the buck, right? This is a break the buck moment in banking, right? You have uninsured depositors getting back, if it's true. And again, I hear this from a good source. I don't know it's a certainty, but it sounds credible that you get back something like 50 cents. And then you get back in a managed liquidation of the bank, whatever they get. And depending on how good a job they do and what interest rates are. But that kind of process doesn't yield the best outcome, right? The best outcomes yielded here, preserving the franchise value of Silicon Valley Bank. And there is real franchise value. Now it's deteriorating dramatically, but with the right collection of investors, something happening promptly, you can restore the institution. You've got to get rid of the board. You got to get rid of the senior management team. You got to bring in a new team. But there, I'm sure, a lot of very talented, loan officers, relationship managers, people who know what they're doing in the bank. And it was not their decision to, buy a ton of Fannie Mae, Freddie Mac, MBS. So this is a solvable thing where the government, actually ends up profiting because they take a nice chunk of the bank for free, if you will, exchange for managing this process. But what shouldn't happen is what, Fannie Freddie was initially like this, and then the government decided sort of to keep the whole thing for itself, and then you put all this $5 trillion of credit risk onto the balance sheet of the U.S. government. I mean, that's another topic for another day. but that is an institution that is, recapitalizing on its own, and it should be an independent public company. But different.
Looking ahead, Bill, looking ahead and trying to figure out what the Fed will do in response. Do you think this changes the Fed's posture or their decision making about rate hikes, whether their posture will become more dovish? Do you expect any of this to affect that?
It may. I think the Federal Reserve will be reluctant to put more stress on the system. I mean, what happened, people get used to, a certain state of play, i.e. rates on a continual march downward for the last, 40 years, basically. And then rates staying at a very low level for a period of time. And then you have a generation of people who've never experienced, a rapid rise in rates. And so they organize their life accordingly. And I would say the person who made the decision, or people made the decision, or the mistakes here were made by people who said, look, there's no world in which we see rates move up massively in the next X number of months. And by the way, the Federal Reserve had that same point of view, right? The inflation was transitory, et cetera, et cetera. Now this is, people say the Fed's going to raise rates until something breaks. Okay, something is broken, okay, in a pretty profound way. So I think there's a decent chance, 50 basis points was in the cards, a week ago, and now people are saying 25. I think there's a decent chance the Fed actually does pauses here and sees, and doesn't, they're concerned obviously about inflation, but this is actually extremely deflationary, blowing up SVB and 65,000 small businesses. That's deflationary, and it's going to scare business people. It's going to make them hesitant. It's going to scare consumers. Like if you can't be confident that what you have in the bank is what you have in the bank, you're going to stop spending money. So the Federal Reserve is looking for a way to really shut down the economy. This is a pretty rapid version.
This is a good way to go.
Yeah, Bill. What if that doesn't happen?
To be clear, they're not looking to shut down the economy. Slow the economy, I should say.
Yeah.
This is going to do it. Yeah.
But what if the rate hikes? And as I prepare to ask this question, Bill, I'm getting videos of people lining up in Los Angeles at the First Republic Bank branch, under the rain, and getting video after video for the last few hours. So my question to you is, if the Reserve Bank does not stop hiking rates, what could happen? What could we expect to see?
I think. Well, look, I think the government has no choice. I've not seen those videos, but it doesn't surprise me, right? What would you do? People are acting rationally, not irrationally. The people who took their money out quickly from SBB, SBB the last couple of days of the week, they're fine. And the people who were quote loyal, and said, oh, that you shouldn't worry about this, are now, I'm getting texts from entrepreneurs saying, what should I do? In various banks, I heard Jeffries is buying, deposits, SVB deposits 70 cents on the dollar. I think that's a disaster, right? I respect institutions. Again, I don't know if it's Jeffries, but I heard various entrepreneurs, hedge funds, and some banks are offering to buy deposits, but that is
Jeffries was one of them. Yeah, I can confirm that. We've had a few send us that information.
Yeah, so I'd heard that as well.
Bill, what are you telling them to do?
My advice is, well, we'll see what happens on Monday. But I think you can't take risk. I do not think it is prudent to take the risk to put your deposits at risk. And if your deposits are at risk, you have to move them to a place where they're not. And today you can get approaching 5% in the U.S. Treasury money market fund. It's totally liquid. It's very convenient. You can often, and that's a lot more than you can get in a typical deposit account. It's a little less convenient when you're writing checks, but you know what? You can keep $250,000 in a bank account or the minimum there, and then keep the rest in a money market account. And that's, I think, what the world is heading toward. And it's unfortunate because the system of low cost deposits and a nationwide banking system is very important for the economic progress of the country. And, the people responsible for overseeing that system. I mean, I blame absolutely SVB management. Okay. I blame the board. But I also blame the government, right? This is a big obvious situation for the FDIC. I'm sure they had people there monitoring or whatever, but this is, they're responsible as well, and they need to fix the problem. And the fix is simple. The fix is simple. Guarantee the deposits. Then people can be calm, okay, and then manage a process to recapitalize the bank, and let the bank move, go forward.
So, Bill, you're saying guarantee the deposits up to what point? 100%?
100%.
No matter the amount. Somebody had 10 million in there.
Yeah, you have to. Yeah, you got to guarantee the deposits no matter the amount, because.
And then what? Yeah. What about across the country and other banks?
Yeah.
You're saying raise the minimum to $1 million?
Yeah, is that the new precedent?
You have to do it. I don't think we can. What you could do is you could guarantee deposits at every bank, and then you could say we're going to be reducing the limit we're going to be increasing the limit from 250 to some level, 25 million, whatever level that's appropriate, where people can feel comfortable dealing with banks. Maybe it's 50, maybe it's 100 million, right? But people are not going to take risk on deposits after this failure if there are losses here. And by the way, the ultimate cost of that should be zero. Okay, the government should be, we should be able to charge deposit insurance. SVB could have paid a lot more in deposit insurance and still have been a very profitable bank. So we should, banks should have insured deposits. They should pay the cost for those insured deposits, and the FDIC, the control of the currency, should monitor banks. Not just on the credit risk of their underlying assets, but the making sure that they don't find themselves in a situation with short-term liabilities and long-term assets, fixed-rate assets.
So as you look ahead, Bill, one of the things that you've mentioned now is the impact of this. If we don't do the right thing and we don't shore up and make people whole, we don't, specifically as it comes to the deposits, I want to be clear about your words, not the shareholders, but specifically those who have deposits at SVB and other banks like it. There's going to be potentially a contagion effect to other smaller banks. What about in terms of sectors? Obviously, this is going to be slowing down growth of the tech sector. This is a stop sign right now. But when we're talking about other sectors and the contagion effect into other sectors, do you think that there will be an impact from this into real estate, into travel and leisure? Are you going to see a lot of this get affected? I know that you have more exposure to those industries.
Sure, it's going to have a general economic effect on pretty much. It's going to hurt the smaller businesses much more than the larger businesses, but that will have a general economic effect in slowing the economy and affecting consumer confidence and affecting business confidence, and all of these things affect the economy generally. And by the way, I'm less familiar with kind of European, Asian banks operating outside the U.S. This can have a global impact. But I think a world in which people can lose money and a bank sanctioned by our government, right? A bank that has FDIC insurance today, now again only for $250,000 accounts, but where the government is responsible is they should be on the hook for guaranteeing deposits. They should charge an adequate fee for that deposit guarantee, and they should also properly monitor these institutions to make sure that there's no risk of to the depositors. That should be their job. And when there's a problem, they should step in. They should smoke the shareholders. They should smoke the bondholders. By the way, if there's an impairment, SVB I think has holding company debt as well. They shouldn't get a free ride here. They're earning a return in exchange for risk. And by the way, those shareholders are sophisticated enough to understand. Anyone who invests in stock of a bank is someone who should understand the risks inherent to a bank. They should be monitoring their institution, and if they should be appointing a board of directors that's sophisticated enough to understand these risks. And if the bank blows up under their watch, they should suffer. Right. So the people making moral hazard arguments are correct, but it should not apply to depositors. Depositors don't have the capability. The vast majority of depositors don't have the capability, the time, the energy, and it's just an impractical world if you had to form your own assessment of the creditworthiness of a bank. right? This is something you should rely on the government for on the deposit side. Hold on, I'm just going to close the door.
No worries, no rush.
Go ahead.
How sustainable is this bill? Bailout, so it's become the norm now, and I agree that the alternative could be a lot worse. But how long can we keep this going on for?
But again, I don't view this as a bailout. I view this as how a regulator should manage a banking system. Banks will fail. Banks will make mistakes. You want banks that take risk. There's certain kind of risks they shouldn't be taking, but there are other risks. The nature of banking is inherent to risks. Bad things happen. You should build in adequate capital cushions. So the loser here are the shareholders and the bondholders who invested in the institution. But the losers should not be depositors who, some guy who's, I got a text from a contractor, who did woodwork, at my house. And he's like, what should I do? I have to worry. What should I do? That guy should be focused on his business. He shouldn't be worrying about losing money in a bank, right? That makes no sense. And there's the whole deposit insurance regime was a brilliant idea of the 1930s. It just hasn't been modernized and scaled up to a level that's appropriate.
And if we don't do the right thing, Bill, what are the long-term effects we'll see for innovation in the US for the tech sector?
Well, I said this almost tongue-in-cheek, but if Russia or China wanted to cause significant harm to the US's competitiveness and the innovation economy, they would have done a cyber attack on SVB. And if they could blow up the bank, it's sort of interesting kind of thought experiment, right? Imagine if there was a cyber attack. It took down Silicon Valley Bank, and they took a massive loss as a result of, a cyber attack. FDIC steps in. Do you think they would smoke the depositors in that case, or do you think they'd step in and guarantee the depositors and allow the bank to recapitalize itself? So the question is, if it was Russia, I think everyone would agree it's a certainty our government would step in and guarantee depositors and save it, right? And again, maybe not save the shareholders, but they would save the depositors. Should it be any different if it's, a ignorant management team that makes a mistake? I don't think so.
Yeah, often self-inflicted wounds are the worst, and so no, I understand the analogy. My biggest worry is the worry of our competition on a national stage. I mean, this is a real national security concern. The concern around the fact that the infrastructure, so across all of fintech, many companies use SVB as their banking partner for their transaction rails. People have brought up USDT or UST and the impact that will have. We've talked about the broader impact of this on the innovation economy. Is this another nail, our chink in our armor as it comes to competing on a national stage against our greatest adversary, possibly, which is China?
Yeah, so for sure. And again, I think ultimately the government's going to do the right thing. The question is whether they figure it out by Monday. I think they'll have no choice by Wednesday or Thursday. So I think, hopefully they figure it out by Monday. And by the way, the damage is much greater if they wait to Wednesday or Thursday because of, the other thing, think about it. It's not just technology companies, right? Think about all the innovative, biotechnology companies, developing, life-saving drugs, developing life-saving technologies that can't make payroll, come this, Monday. And once these, that is, catastrophic. Catastrophic.
Yeah, Bill. Hey, Bill, if this idea that you would turn deposits up to 25 million insured, or whatever that number might be.
I mean, I think
what would that?
I think you have to make it unlimited at this point. And then the question is whether there is some level that once you get everyone safe and comfortable, and the government decides they don't want it to be unlimited, they want it to be at some limit. But I think I think it can be effectively unlimited as long as deposit insurance premiums are paid, guarantee premiums are paid, and there's proper oversight. I don't think you should be I don't think you want consumers or business customers of banks worrying about losing money on deposits. These are often
And just in line with that, because Friday I got a phone call from my banker. He initiated the call and wanting to tell me, "Hey, we're good," which I thought was interesting because I've never gotten that phone call in 20 years. And the idea that if you raised it to what does that influence the confidence in the dollar around the world?
Your mic, your mic is gone. But I think it's the influence on the US dollar.
Your mic we can hear from you while we're waiting for Grant. Go ahead, Andy.
Yeah, I guess I wanted to just say a couple of things. One, as it relates to the FDIC guarantee, it's important to recognize that this bank had 97% of its depositors uninsured, which is extremely unusual across the global banking system. And as it relates, and so that's a very important difference versus the rest of the system. And I guess the second thing that I'd ask Bill,
Andy, does that mean that they weren't insured for the 250,000?
They were not. They had a bigger account than the 250,000. So they are at risk to receiving less than 100 cents on the dollar because of the $250,000 limit, which, by the way, is a congressionally determined number. The FDIC doesn't just pick that up and say it's okay. They're putting the whole faith and credit of the U.S. government at risk when they make that guarantee. But as it relates to the idea of unlimited FDIC insurance, I think it's very important that you recognize that there is a very big cost. And that very big cost is if our banks were 100% guaranteed by the U.S. government, no one would finance the U.S. government when they issue bills.
Well,
and Bill, that's basically the
Bill, what are your thoughts on that? So I'm on 1 second. Bill, do you agree with that concern that Andy just brought up? That's a good concern.
Well, first of all, the notion of unlimited, I think it doesn't need to be unlimited. That's sort of number one. I think there can be limits. I'm saying when you're in the midst of a crisis, you need to make it unlimited. It's a bit like the mutual fund crisis. You can't tell people, look, we'll guarantee 98% of your balance in your mutual fund account or 90 cents on the dollar. That's not going to stop the panic, right? You got to tell people they're totally comfortable regardless of what they have.
Right. And the question
and then you can later, after the fact, you can say, okay, what's a sensible level for people for business balances, where you keep your capital. But I think there are many reasons why you buy treasury bills versus keep your money in a bank account. Often bank accounts pay less than treasury bills, so that's a reason to obviously buy treasury bills. Banks offer convenience and help. They're easier for payments, etc. But I'm not particularly concerned about that risk. And there's also a global market, for treasury bills. But I think there's time to figure out what an appropriate level is. But $250,000 is clearly too low. And while I agree that SVB is an outlier at 97%, but if the statistics I've read are correct, I think there's something like 50% of the deposits banks around the country are uninsured, or at least effectively uninsured because they're in excess of the $250,000 limit.
So as you're looking forward, we talked about what the right thing to do is. We talked about what would happen if they did the wrong thing. I don't know if we explored that enough, Bill. Again, if they don't do the right thing, SVB falls, people are not made whole. There could be a contagion effect. You have brought it up on the smaller banks.
Okay, it's not just smaller banks. It's every bank. I mean, the other thing that's kind of seems wrong to me is the government's effectively said, look, we've got these systemically important financial institutions, and we're going to bail those out. Okay, so you can feel comfortable as a counterparty dealing with those institutions, and we have a precedent for doing so, and this is what we're going to do. For everything else, it's $250,000. That to me seems wrong. And if you think about this administration, they're totally opposed to. It's hard today for one company to acquire another, any kind of scale, right? You see, almost every decent-sized transaction is being challenged by the FTC. Here's a way. Okay, SVB is allowed to fall what it will do, it's already having this effect, I'm sure, is it will massively concentrate the banking system in, the handful, the top 3 or 4 banks in the country. And that's the outcome of an announcement that people are getting 50 cents on the dollar on Monday, right? And I don't think that's a desirable outcome. And again, I think it's important to, at least this, until technology replaces the system, having a network of, if you live in, somewhere in Idaho, and you got a farm, you got a local banker who meets the farmer, assesses his, character, creditworthiness, the quality of his land, and makes a decision to lend him money, to buy a new combine, right? For working capital. And he makes a decision not to make the same loan to the farmer across the street because, you know what, his soil is not as good or he's not as good a farmer. That can't be done by 3 major banks, right? That's done by a local banker. Someone you walk into is the bank and you sit down with your banker and they understand you. They know that you're getting divorced. They know what's going on in your life. I think it's actually a pretty good system. That basically begins to go away on Monday if what happens is people, don't feel comfortable keeping their money in a local institution. And I think that is definitely bad for America.
Bill, I'm just wondering how you think about the politics of this situation specifically, because what you're offering is a very nuanced perspective. And I wonder how many Americans truly understand that. And especially because the bank is called Silicon Valley Bank. And I wonder if most Americans just associate what you're talking about as a bailout of big tech in some ways.
Sure. So I think, look, the obligation of our, leaders is to be good communicators. And if they're not good communicators, they should hire good communicators to explain. And I think the explanation is pretty straightforward here. This is what the government's doing is protecting depositors. It's not bailing out investors in the institution. And the depositors here are, for the most part, these are small, fast-growing businesses that have raised capital from venture capitalists that are employing a lot of people who are, giving up. Generally taking less cash compensation in exchange for more equity compensation. And they're often the best and brightest and most motivated, people in our country. And, these are companies that become the next, Google, the next Tesla, the next SpaceX, make your list of companies that wouldn't exist without our system of venture capital. And these are companies that employ, hundreds of thousands of people and that have made life safer, easier, better, cheaper, cleaner. This every country in the world would love to have a Silicon Valley, right? It's, I would say, one of the most important drivers of our economy and our competitive advantage, and frankly, our competitive advantage, from a national defense point of view. Think about all the startups in AI, right? Do we want those to become bought on a distressed basis by foreign companies? To raise capital from places where where people are not friendly to the United States, or to move offshore? That would be obviously a bad outcome. So again, I'm not a member of the community, which will make me able to make the case for the community. But I'm a huge believer. Whenever I'm disappointed or depressed about our country, I need to get optimistic. I call a friend who's a venture capitalist and I ask them what they're working on, and that's what gives us all hope.
Bill,
You mentioned
just
earlier
wanna ask
about
a
the tech
question,
replacing.
Sorry, Bill.
So
Sorry, Dan. Just one
wanted to touch base about something, which was, you mentioned a sentence, and just so you know, Bill, at least 20 people have messaged me separately about that sentence, which was tech replacing the system. And, right now the system is showing all of its flaws. One, do you think that this could be a moment that catalyzes, because this is happening to the innovation economy, that this could catalyze the movement of the tech of the financial system to a tech-based financial system because of what's going on?
Yeah.
Do you think this is a catalyzer?
For sure.
And what do you think that system that the new system would look like?
Look, if relying on centralized financial institutions, there's a risk inherent to that. If you can replace a centralized financial institution with a system that, the whole sort of crypto blockchain economy, I think that's, sort of the mission, right? And so there's merit to it. The problem is that, the community hasn't served itself well with, FTX and others. But I do think, yes, a world in which you don't have to rely on regulatory oversight and regulatory capital requirements, where it's, built into the blockchain, and you can know for certainty that your capital can never be taken from you. But yes, of course, it motivates you to consider alternative systems when the basic one, which is, which our government and our regulators oversee, fails you, for sure, of course.
So the question I have before we go to Vinny and Sleiman, could this be, so 08 financial crisis was a catalyst for Bitcoin. Could we see this as the catalyst for Bitcoin to decouple as a store of value, or is that wishful thinking?
I don't own any Bitcoin. I think it's a kind of a brilliant construct, but you worry about it. Will quantum computing disrupt Bitcoin? I'm not smart enough to know, but I'm still, my approach is to be really careful where we keep our capital. I deal with, I keep my personal assets in one financial institution, and there I keep really a minimum amount of assets in cash and the balance in a U.S. Treasury money market account, where I buy U.S. Treasuries directly, and that's how I kind of run my business, because I'm sort of credit paranoid, and the nature of my business allows me to operate that way. But if I were, a small business person in a community that didn't have a real presence from one of the big banks, what these smaller banks offer is a real, there's a banker you can talk to and sit down with and get advice from, and that's a valuable and important service, a help driver of our economy. I'm able to avoid that. Although having a banker you can talk to I still think is a valuable thing. So I do think the system is a good system. Occasionally we make mistakes. And if we make mistakes for political reasons, there'll be long-term political implications, right? This will be a disaster, in my view, for the Biden administration if this thing goes down poorly on Monday. Because the president ultimately will be, he's the, our leader here. So he's ultimately responsible. So if his regulators and his, kind of let the country down, he'll take the fall.
I've got Sleiman and Akshu. Akshu, I'll let you ask your question first, and then I'll get Sleiman afterwards. Akshu, do you want to go with your question, if you don't mind?
Yeah, for sure. Hi, Bill. In your post today, you mentioned that in the absence of government intervention on Friday, basically SVB's 40-year franchise value was destroyed. And you mentioned that had the government guaranteed deposits on Friday, perhaps even Pershing would have been interested in participating in an equity injection. So I was just wondering if you could dig into that a little bit more. And do you think that there is any franchise value remaining? Do you think there's room for private intervention, or is it purely on the government at this point?
Yes. So I think in the path we're on now, all the franchise value will be destroyed. But if very quickly, things are resolved differently on Monday, I think the franchise value can be preserved, right? I think the key is, guarantee of deposits, and then an appropriate process where kind of well-known, and again, I think the venture community, GA's, story about General Atlantic investing $500 million, I think, instinctually that sounds like the right thing, right? You want the people who've got exposure to the institution, who trust the institution, have relationship with the institution, and know it best to kind of lead a recapitalization of the institution. That's a sensible, approach. And I think if it happens, you protect the depositors, you let the bank continue to function, people can draw on their, credit facilities they have at the bank, it continues to operate, it could we'll look back and it's a hiccup. The key after that is one, sell the long duration assets, turn them into treasuries. You can get a nice, attractive yield. that kind of stabilizes the bank immediately. Then you figure out, what the hole is. I think that transaction, they've got a mark-to-market loss in their MBS and whatever 2-3 year Treasury portfolio that's more than sufficient to wipe out basically wipes out the equity capital of the bank and maybe impairs some of the bondholders. You may want to preserve. This is a case where actually protecting the bondholders may make sense because these are people you may want to borrow money from in the future. So I think actually bringing in sufficient equity, keep the existing debt outstanding, protect the bondholders, I think is actually a sensible solution. And you raise a fortress amount of capital so that this thing is clearly safe. And then you bring in a best-in-class leadership team that actually, I think one of the problems with this bank is it thought of itself a little too much like like its customers, right? And I think it should be run more like JP Morgan. It should be entrepreneurial. It should understand the space at which it operates in, but it shouldn't be making stupid loans to get cheap warrants on startups. And hopefully it's not doing stuff like that. But I think the new leadership team should be a very mature, banking savvy team. I think in that case, I think the community would be supportive of the institution, and you keep all the relationship managers and the rest of the employees who weren't responsible for this stupid mistake, and life goes forward. I think the bank's fine. But I do think the watershed moment is, you have to do this. You got to change the whole FDIC deposit regime. So we can't have runs on banks in the United States. It's frankly embarrassing. Okay,
But Bill, hi. I think we're of like.
Hey everybody, it's Brian Sullivan. I was wondering.
Go ahead, Brian.
Hey, thanks, and thanks, Bill. I appreciate it's Brian Sullivan of CNBC. Appreciate your take and being on this space. Just a couple. I want to get your take on two things. I mean, and maybe this was addressed earlier. If it was, I apologize, everybody. Is there any kind of an estimate of the value of the privately held, private company stock, the warrants that they took? I mean, they took, unlike with most venture debt, they were taking, warrants on some of the early stage stock. And I've spoken with a couple people today, and the estimates of what the value may be are all over the place. Wonder if you had a thought on that. And then also, the FDIC chair last month gave a speech where he said there's $620 billion in unrealized losses on banks' balance sheets. St. Louis Fed had a report a couple of months ago on that. I mean, I'm not saying we should have seen it coming either, but it seemed like there were some high-level warnings that just went completely ignored.
Okay, so two questions. So I don't know the value of any warrants held by SVB, and I'm speaking from a high level perspective, having not done a detailed analysis of the bank. I was cautious about the bank enough so that an investment I made a couple months ago, I insisted that when the founder wanted to put capital in SVB, I said, what, you pick a B of A, JP Morgan, pick another bank. I have some concern. Okay, and that was just instinct based on what's happened to the tech sector, and he was appreciative that I gave him that advice. But this institution needs to be set up in such a way that you never have that concern again. But the fact that there are mark-to-market losses on securities held by banks, that they, as long as they have the ability to hold those securities to maturity and they don't comprise a massive percentage of a bank's balance sheet, it's not something that should create systemic risk. I mean, I think there are, perhaps some other banks that have, disproportionate exposure, but I do think SVB was an outlier. And the reason why it was an outlier is something unusual happened, right? Because of the sector in which they operate, and because of the growth of, venture and enormous amount of capital that flowed into startups. They were hit with an overwhelming amount of deposits in a short period of time, and because of the pressure to generate results, my guess, they put them in what they thought to be safe instruments, and they reached for yield, and they didn't think about the fragility of their deposit base because it's a 40-year-old institution where this never happened before.
Were you afraid of the bank's balance sheet when you said go JP Morgan, B of A, anywhere else? Were you afraid of the company itself, or just the
no? I'm just a simple guy. I'm like, why? The advice I've always given for years is I just, the nature of the business you're in. I just took in a pile of money. This company raised, it's actually a company that we're helping restructure the tennis industry, and I don't want to have to think about any risk. I'm chairman of the board of the business. I don't want to have to think about any credit risk in the business. We got other risks that we want to focus our energies on. That was the instinct. And I don't know the SVP well, so I just go with the institutions I know well and I trust. But again, the community here, this is an institution they know well and they trust. That screwed up. But it looks to me like, it's a CEO mistake, right? And it's a board oversight mistake, and it's a chief risk officer mistake, and it's an asset liability manager mistake. I don't know how many employees they have, but I'm sure it's into the thousands, and I would say the thousands didn't make a mistake. So, and I think my guess is they've got a lot of lending to early stage, and by the way, looking at their balance sheet, they don't have a ton of assets as a percentage of their assets exposed to early stage startups. It's a relatively small part of the balance sheet, and I would guess they have better expertise at doing this than other banks. And I think it's a good thing. I think it's an important part of the venture growth ecosystem to have a bank that understands their needs. It's a bit like banks that understand farmers' needs. It's important for agriculture in our country, and people develop particular expertise in handling a community of borrowers. It's kind of good for America. So,
and not to forget that.
Go ahead, Danish.
Hi, thanks. Yeah, so obviously Silicon Valley Bank, they bank the wine industry as well, which is pretty. It's pretty important to Northern California in particular. Bill, one thing I will ask is, I've been on this Twitter Spaces this morning for quite a few hours, and we were discussing what is the failure here. And my view on this is it's a regulatory failure. And so the mischaracterization of calling this a bailout, which is what people are trying to do, the ones who are opposed to resolving this, in a way which I think has minimal impact, is a problem. It's the theme and narrative they're trying to build around it being a bailout is wrong. It's a regulatory failure, and if we don't fix this, you're going to lose faith in the banking system, and we're going to have bank runs all week. And you've said this as well. What's your take on the narrative that's forming around the bailout?
Yeah, I think people don't actually understand the system, understand the facts, and also where the notion of any government capital or credit being used to save a private institution is a mistake. And look, I'm a capitalist. I'm a free marketeer. I believe government intervention should be limited. I think government's, too big. I think there's a lot of waste in government, but there's some very, very important functions that government serves, and among them is the management of our, deposit-taking, banking system. And another bad outcome from this, politically, is if some, the Elizabeth Warrens of the world use this as a way to say, whoop, banks, you need to hold more capital. We need more regulations. And the answer to that is really no. The banks are actually, as well capitalized as perhaps they've ever been in our country. This is an issue of, yes, at first it's a management and board failure, but also it's an oversight failure. And so it's unfortunate. It happens. People make mistakes, but you make mistakes, you learn from them. I call that experience. But this mistake, asset liability mismatch and liquidity issues are, kind of banking 101. So I would say it's a bad mistake. The people should, suffer the consequences, and the people are the management, the board of directors, the regulators responsible for not properly overseeing this one. But the punishment should not be borne by a bunch of 65,000 apparently growth companies, startups that are providing, a good friend. A woman runs a startup that provides, pediatric advice for parents on, like, you text a picture of, something on your child's 3-year-old skin, and they give you an answer pretty quickly on whether you need to go to a dermatologist or how you, interesting startup, Sequoia backed, very talented entrepreneur. And unfortunately, she has kept all of her capital at Silicon Valley Bank. She doesn't know what to do, right? I mean, should she be out of business because of a decision made by a CEO or an asset liability manager or investment person at this bank, and because a regulator wasn't paying attention? Is that the right? Is that punishing her appropriately? No. It makes no sense. So I just think once you think thoughtfully about the circumstance, I think it's really hard to politicize. There are no fat cats making off here. The investors will lose their money, and the people responsible should be held accountable. It's a bad look for the CEO, the CFO, and a bunch of other officers selling stock in the last couple of weeks. The SEC will have its view of that. But this does not need to be a crisis, and we're heading to a crisis. We're in the midst of one, and we're going to know it for real. Unfortunately, I think in the next, we only have. When I wrote my tweet this morning, it was 48 hours to go. There's now less time.
Less than 48 hours. Slayman?
Right.
Yeah, Bill, I just wanted to ask a question from a different perspective, because I think a lot of people on here are like tech people, and so we're getting one perspective. But the other one is, look, from a normal person, an average American, the way they view it is this, that, what's happened is when people deposited money or took credit from that bank, they took a certain level of risk. Now, and also we've seen from certain sources that a lot of people, what they did was to get credit, they then did their deposit for that specific bank. And so if you have a scenario, and if you really live in a capitalist society, a free market society, these people should not be bailed out. They took the risk, and the average person who's actually struggling should not have to basically compensate for that risk. So what's your answer to that, from that specific perspective?
Sure. So first of all, you should ask the people who ask that question, say, well, what if you woke up tomorrow and the bank where you have your business account is, you no longer have access to it, and you maybe have access to half of it, and the rest is this uncertainty. And by the way, it's a regulated institution. It's got a BBB plus, investment grade rating from Moody's and S&P. It's been around for 40 years. Not a fly-by-night operation. Do you feel like that's an appropriate outcome for you? How would you respond to that? So I would ask them that question. And two, I think this can actually be a costless rescue, in the sense that, again, they actually had a fair amount of equity capital. They have a pretty transparent, for the most part, relatively low risk, asset side of their balance sheet from a credit perspective. They made a really big mistake on rates. You can kind of quantify that and fairly easily liquidate that collateral. You can figure out what the hole in the balance sheet is, and there's real franchise value here. I mean, this stock was, probably, obviously stupidly, but it was, I don't know, $700 a share or something not that long ago. There's certainly implied franchise value there. You've seen the impact it's had on the community, and a lot of people actually, to their jeopardy, kept their account with the bank kind of out of loyalty. That gives you a sense of the franchise value of an institution. And, while someone else, maybe, there'll be a bid for all of the loan assets of this bank, it's not going to be a great bid, because not very many banks have the capability to analyze each of these individual loans, or the kind of the expertise to manage a loan book like this. So the bid's going to be, much lower than it should be. And then there's going to be a loss of access to this, kind of capital, which is going to increase the cost of capital for, startups and growth companies, which is going to make, it harder for those businesses to succeed, which means less innovation, which means, less healthcare, less, which means the advantage goes to China. The advantage goes to our global competition. And I think that's bad. I don't see how we win, from that outcome. And so it's, again, I think it's pretty straightforward. It's deposit guarantee, make everyone feel safe. It's a process, and you run a competitive process so that you get the best. Get the best outcome. You figure out who the right investors are. And this thing's back in business in a normal way. I mean, one of the things that I haven't read an article about. It's not just the people who have deposits here, right? It's people who are relying on access to a working capital line. People who, if you post a letter of credit on a lease and it comes from SVB Bank, and the bank defaults, now you're in default on your lease, or you have to post a letter of credit for some obligation, and typically you have to put, dollar for dollar capital into a bank to support a letter of credit. Well, now you don't have access to that letter of credit, and you don't have access to the account. So it's going to have very profound. It's interesting when there's like a bank failure. It's a bit like the Lehman moment. People don't understand. Everything seems calm because it's the weekend. It's like, okay, the birds are still chirping. The people are still walking around. Everything's fine. And then, it wasn't long after Lehman for people to realize what the implications are. This is absolutely a Lehman Brothers moment in our history. And
so Bill, Bill, you brought up over the weekend. It seems like most of these events are somehow timed or managed to release over the weekends. How long do you think they've known there's been a problem, and do you think that they, really made it apparent on Friday afternoon so that they had the weekend, or they could buy 72 hours?
I think they've known they've had a problem. They had to have known they've had a problem for a while, because the obvious problem is, as the Federal Reserve keeps raising rates, the marginal attractiveness of keeping your money in SVB versus putting the money in U.S. Treasuries, obviously, so you're starting to see flight of deposits. I'm sure again, I don't know the specific details. I'm sure they saw the flight of deposits. They understood every minute the mark-to-market value of their mortgage-backed security portfolio and their Treasury portfolio. So they absolutely knew this was coming, and that's why you do not want to be selling stock into this if you're an officer of this company. And 3 weeks ago, whatever it was, that's not a smart strategy. So clearly there's some people here who are not thinking sensibly.
Bill, why wouldn't the Fed just step up and go and buy the mortgage-backed securities and provide liquidity immediately?
The issue here is not you can get liquidity. The problem was, they're sitting from an accounting perspective. They only mark to market. They're held for sale securities, and so those are the securities they sold and took a cash loss. But they had already recognized the mark to market loss there. The problem is the held for till maturity portfolio, which under the accounting rules they're not required to mark to market. So those are held at cost. And once you sell those, okay, they're no longer held for sale, and you got to mark them on the proceeds you get from their sale, and that's why they didn't sell them. But the embedded loss was there, and I think as long as they believed they had deposits, I think they probably had the view that they could hold those to maturity. But deposits were leaving, obviously, and they saw the writing on the wall. And there's only so much they can borrow from the whatever Federal Home Loan Bank or whatever, the Fed, wherever they borrow from. And at a certain point in time, they had to actually sell the held for sale portfolio, and that sort of was the wake up call for the market.
Well, I know it's a Saturday, so I wanted to just interrupt and ask you how much time do you still have?
Not much. I think I'm overstaying my welcome in terms of my parental responsibility, but I think it's an important conversation. And I hope someone in our government is paying attention, I'm happy to answer a few more questions but I think we've covered most of it.
Sure, we'll take maybe two more questions. Cantro and Wolf. Cantro, do you want to ask the first question? And then I'll wrap it up with the final question.
Thanks. I'll make it quick. Just coming back to the Fed. So, Bill, you mentioned a couple things that kind of caught my attention regarding around that. You mentioned the Fed, or something's broken, and perhaps the Fed should stop now. However, if the FDIC backstops everything unlimited next week, and if SVB was a outlier, as you put it, should it really, and putting aside your inflation view or whatever, and my inflation view, whatever, if you're Jerome Powell, should you really stop, given those two, if those two things happen, or if it's true, it's an outlier, and if the FDIC steps up and makes everyone calm, as you say?
Well, I think that'll go a long way to calming things, but I think a calming, and that's a pause moment, and then a recap where this thing's kind of back in business. I think that's a confidence builder sort of moment. My view is the economy's actually is much stronger than the Fed has up until more recently kind of recognized. I think inflation is here to stay, not at 5%, but certainly, but not at anything close to the 2% levels that the so-called target that they're pushing for. So our, if you will, house view is the world is a structurally different place, and the outcome of that is we're going to have persistent, 3% plus, 3.5%, possibly 4% inflation, for the long term. It's a different world when you decouple from China. We've had this massive subsidy, from globalization. We had a massive subsidy, frankly, from technology companies that were underpricing products to build market share. There's, I think, a restored focus on profitability. That subsidy, I think, is quickly going away. I think the war in Ukraine, obviously, is an overhang. The incremental cost of defense globally is going to be inflationary. I think, I think the list, sort of goes on. So I think you're going to see persistent inflation at, let's say, like, I hope it's something more like 3%. I think that's a more kind of realistic target. And the Fed, if you look at the kind of core inflation numbers, we're closer to 4 than 6. And we might even, there's indications that we're getting to, middle threes, middle three, approaching 3.5 in terms of, levels of inflation. So 5% inflation, 5% Fed funds is restraining, is starting to hold back the economy. I think actually the problem with is that I think what doesn't make sense to me is where the kind of longer term part of the curve is. And I think the longer term part of the curve has a big impact on the economy. And I think rates are, the longer term rates are too low. And I think we're getting closer to where short term rates have to be. But I do think the Federal Reserve is going to be, Jay Powell is going to be concerned about causing something else to break. I think it's really important how this thing gets managed. If it gets managed poorly, they're definitely not raising rates, and they may be forced to lower rates. And I think that is something they don't want to do because of their fears about inflation. So
I'm going to give the mic to Wolf for a final question. But before that, I did get a video. Not sure if anyone's seen it or has just leaked. I've just tweeted it from the CEO of Silicon Valley Bank, or now former CEO. Sent a message to employees last night. I've just tweeted the video. Should be up any second. But Wolf, I'll give you the mic for a final question to Mr. Ackman before I wrap it up.
Sure. Thank you, Mario. Yeah, a lot of questions and a lot of people flooded my DMs with good ones. But one question which I think is pretty important here is just, Bill, how important is Monday? What if the Biden administration does nothing on Monday? What would you ideally like to see happen on Monday to contain this from blowing up and really overtaking a lot of other banks?
I think, by Sunday night, or certainly before markets open on Monday. I'm aware of large borrowers from other non-SVB institutions that have set up wires to go out first thing Monday morning. It's just a prudent risk management thing. And I would, every day you wait, you start destroying other franchises, and you increase the risk that you're going to have to do multiple rescues. So I have to believe they're focusing on that. And so I think hours matter. You don't want the market to open and see, regional bank stocks, smaller banks, banks that have concentrated exposures to certain sectors, plunging. And people now know that if you're late to take out your money, you could get stuck. That's the lesson from Friday, right? So you're going to see faster movements of money come Monday, absent a pretty dramatic and aggressive statement from the FDIC and our Janet Yellen and others about what we're doing to preserve, our banking system. I mean, that's what we need. We need to restore confidence. But anyway, look, I think I appreciate your questions. I think it's a very interesting, forum. I also say I'm not guaranteed to be right about anything. I'm just giving my own personal assessment. I think this is really, really important. I see enormous downside in terms of what I hear the government's intending to do on Monday. And I see basically de minimis, if any, downside to clear the air. Let's protect depositors moment for our banking system. And let's get this institution back on its feet. Let's, there are thousands of people, I don't know, 65,000 companies backed here, 65,000 payrolls this week. What's the average number of employees at these companies? We're going to be well into the 1 million+ people at just, if these are just small startups that are going to be impacted in the very, very short term. And then I think about the implications for our, long-term competitiveness. It's hard enough. My last point here is the environment for being a founder, startup CEO is a very different one in terms of access to capital, versus 18 months ago. And all of these companies are focused on, extending their runways, getting to profitability, and at a time where, we could be heading to a more challenging time economically. The last thing they need is to wake up on Monday and find out they don't have access to their deposits. That is going to be a very bad moment. So let's hope the government does the right thing.
And Bill, last comment. I ask this for every special guest we have. It's unrelated to the topic, and that's what you think of. I know I've seen you in the spaces and when we were covering the FTX story. I'd love to get your feedback on what Elon's building with Twitter Spaces as a way to cover breaking news live. Would love your objective thoughts on the experience on the panel and also in the audience.
Are you talking to me? Is that a question for me?
It is. Final question.
Yeah, so I'm actually a huge fan of Twitter. I think and I have to disclose a little bit of a tiny conflict here, as I threw in a small investment into the Twitter going private, with Mr. Musk. So I'm a tiny owner of Twitter. I did that more, in the spirit of free speech, as opposed to something where I was expecting to, make a profit. Although I think it very well could be a successful investment. But, we've gone through a period of time where people have lost a lot of confidence in media and, challenging period to figure out truth. And I do think that having a place where a very, a constitutional understanding of free speech is allowed to take place, and where everyone is given a platform to be a publisher, if you will, of news, I think is really a remarkable thing. And I got interested in Twitter. Really, I signed up, let's say, in 2017 when actually Steven Pinker said to me, that this is how he gets all of his, knowledge by following certain people on Twitter. I'm like, okay, that sounds pretty cool. And but I didn't tweet. It was really not until the pandemic, or the kind of very early days of the pandemic, and I don't know, late 2019, early 2020, I got worried about the pandemic, and I started following epidemiologists and interesting people, and developed kind of my own view on what would happen in the pandemic. That I realized how powerful this form of media is, and I think the Spaces thing is really cool. I've used it generally. The only one I've been on before this was just kind of following what's going on in Ukraine, and I found it to be a very useful way to get. Actually, when I pay attention to Twitter, and my wife will tell you that I spend a little too much time here, I always feel like I'm reading the newspaper, days, often, occasionally weeks in advance of the news, and I think that's a pretty powerful thing. And then lastly, a lot of people made fun of Alon here for the price he paid, but any business where you can replace 80% or eliminate 80% of the employees, not to say that he did it in the best way, or 75% or whatever the actual numbers are, there's been more improvements in functionality and the technology of Twitter in the last, since he's owned it, whatever it is, 5 months or something, than there was in the previous, 5 years of my being, kind of a quote unquote a member of the community. So I'm bullish on Twitter, and I think it's my guess is it will end up being a profitable investment. But I think more importantly, there's a place people can go and hear all sides of an issue where there isn't going to be government. If you haven't already followed, if you will, the Twitter files, the notion that the government is working to suppress certain kinds of content is a really frightening prospect, and I feel a lot more comfortable that that's not going to take place, certainly in this form of social media, and that's why I find it a better source. And by the way, I follow people who have completely. I try to follow people who are smart, whether.
I think Bill just got a call. And talking about the Twitter files, we've been covering it here live, and I think most of you know that. And while waiting for Bill to give us the back.
The Spaces thing is really interesting. I've never actually spoken in one, so kudos to Mario for organizing and for government and do it anonymously. I think that's also a good thing. All right, guys, I really appreciate the time and
thanks a lot,
for
Bill.
doing this.
Appreciate it. Thank you, Bill. And we're gonna and Bill, by the way, if you're in the audience after this, we're gonna play the video of the former CEO of Silicon Valley Bank now.